know what's strange? The smartest investors in America are ignoring luxury high rises and quietly buying 30-year apartment buildings. Why? Because Class B assets are becoming the most powerful weapon in real estate's next wave of consolidation, and nobody's talking about it. We're entering a new era in multifamily real estate. Class A properties too expensive to build, too risky to hold. Class C properties too operationally unstable, especially in tougher markets. Class B, that's the sweet spot. They're old enough to be affordable, stable enough to attract working class renters, and perfectly positioned for institutional repositioning. Here's a twist. This isn't a short-term trade. This is a 10-year consolidation play, and the big players are already moving. So let's rewind. Back in the early 1990s, Sam Zell built the largest apartment empire in the U.S. history. How? By buying Class B assets at discounts during a dislocation. Today, institutions like Blackstone, Starwood, and Greystar are doing the same thing. But this time they're doing it with smarter tech, deeper data, and a war chest of dry powder. But why Class B? Because new construction has slowed to a crawl, because Gen Z renters are priced out of the Class A, because the middle class still needs a place to live. This is about volume. Class B buildings don't make headlines, but they do make portfolios bulletproof. So let's talk numbers. Construction starts are down 40% year over year. Class A vacancy is rising in gateway cities, some markets over 10%. Class B rents, meanwhile, are holding steady. And in some metros are still growing. And institutions are noticing something else. The renovation delta, 15 to 25,000 per unit upgrade on a Class B can yield 10 to 25% rent growth. The demographic moat, blue-collar households and essential workers aren't moving out of Class B communities. The margin of safety, most Class B assets were acquired pre-2020, meaning they still pencil, even with higher rates. Institutions love asymmetric risk, but that's exactly what Class B offers. So here's what you won't hear in the press. Institutional buyers are building shadow acquisition pipelines. They're targeting 1980s and 90s garden-style apartments, 100 to 300 unit assets, located in landlord-friendly states, run by operators struggling with capex or leasing velocity. They're not buying on market, they're buying through distressed debt, off-market broker relationships, direct-to-owner calls using AI underwriting. And once they acquire, they move fast, implementing centralized management, bulk purchasing renovation materials, streamlining payroll and utilities, pushing NOI within 12 to 18 months. Their thesis? Own 10,000 units of stable, recession-resistant cash flow. So here's how institutions are structuring these deals. Debt, 50 to 60% LTV through regional banks offering 5-year fix, 5.75 to 6.25%. Preferred equity, 20 to 30% from family offices, seeking 8 to 10% preferred returns. Common equity, 10 to 20% from REITs and sovereign wealth funds. The magic? They're layering in tax abatements and opportunity zone benefits to boost levered IRRs to 14 to 18%. Now, institutions follow with 3-phase renovation playbook. Phase 1, months 1 to 6, replace floor counters in 20% of the units, install smart locks and video doorbells, launch AI-powered leasing campaigns. Phase 2, months 7 through 12, overhaul clubhouses with co-working spaces, add packaged lockers and pet spas, implement sub-metering for utilities. In Phase 3, months 13 through 18, raise rents 15 to 25%, refinance to stabilize NOI, package portfolios for sale to REITs. Now, institutions are also winning the occupancy war with flex leases, 6 to 18 months term with 10% premiums for longer commitments, essential worker programs, discounts for nurses, teachers in exchange for a 5-star Google review, community apps, tenant portals offering handyman services and rent reporting to credit bureaus. And to combat 30 to 70% premium hikes in insurance, the top players are self-insuring, captive insurance subsidies covering first $250,000 in claims, climate proofing, installing impact-resistant windows and flood barriers, lobbying, pushing for tort reform in states like Florida and Texas. And smart buyers are exploiting. You see cost segregation, front-loading depreciation to offset year 1 to 3 income, like-kind exchanges, rolling gains into opportunity zone funds, state incentives, capturing workforce housing credits in 14 states. And institutions are hedging against rent control, buying in states with preemptive laws like Texas, Florida, and Georgia. Recession, underwriting a 70% occupancy and 5% rent declines. Interest rate spikes, using interest rate caps and swap agreements. Now, if you're not Blackstone, do this. Partner. Joint venture with regional operators for scale, specialize, focus on niche asset types, senior housing, student adjacent, leverage tech, use platforms like Rent Spree or AI-driven underwriting. And most small and mid-sized investors still chase trophy assets. But the real money is made by buying what no one else is paying attention to. And here's what to watch. Look for 1980 to 2000 vintage assets in markets with job growth. Pay attention to leasing velocity and capex backlog. target owners with bridge debt maturing in the next 12 months. If you're a broker, align with these trends. If you're an owner, reposition before institutions outprice you. If you're an investor, underwrite for durability, not flash. Because this isn't about trends, it's about timing. And institutions are already 2 quarters ahead. Now, there are some new risks emerging in 2025. Rent control proposals in 12 states, insurance spikes hitting Class B hardest, and local ordinances requiring seismic upgrades. And after acquiring Air Communities for $10 billion in 2024, Blackstone is now converting Class B to Class A, securing assumable debt between 4 and 5 rates, partnering with prop tech startups to automate management. For sellers, stage units with 5 to 10,000 upgrades, extend leases 18 to 24 months, bundle portfolios. And for buyers, target 1980s properties with vinyl siding, avoid C disguised as B, lock in 5-year debt now. See, institutions aren't just buying apartments, they're buying neighborhoods, they're buying cash flow streams, and they're buying demographic inevitability. This isn't just about real estate, it's about capital flows. It's about demographic density, and it's about who controls the last remaining affordable housing stock in America. In 2025 to 2027, the window will separate the prepared from the panicked. The clock is ticking. The institutions are already moving. Where will you be when the music stops? In the next video, I'll show you exactly how institutions are underwriting these deals, what CapEx assumptions they're using, how they're modeling rent increases, what submarkets will outperform by 2027. Don't miss it, because the game is won before it's played. And let me show you why.